Hi, everyone. My name is Sara Shikhman, and I'm the managing partner here at Lingia Law. We work with lots of different healthcare practices, helping people start practices, get investors, sell their practice, buy other practices, and everything in between. I've been practicing law for almost 20 years. We've helped businesses of all sizes, from 50 to $100,000 deals to $50 million deals. We've done them all. And joining me on this webinar today is Samara Bell. She is also a very experienced attorney. We've been practicing for about the same time, actually. I'm surprised we didn't know each other in college somehow, but we've done lots of deals and we love representing people and helping people get the most value for their practice. And I hope you enjoy this webinar on how to really position your practice for maximum investment or sale. Hopefully, what you'll come away with from the webinar is that it's not just about having great revenue or being a great provider. It's more about having the organizational things in place and having systems in place to position yourself. And we've seen it all. We've seen a transaction where someone was selling their practice and then like the day before closing said, well, there was this like one lawsuit where like after hours I did this and this with the staff member, but it's not a big deal. Don't worry, we don't have to think about it. And I'm sure Samara has other interesting stories like that. But it's not even just about that. It's about positioning your practice to get the maximum value. And we'll talk about how to do that. Like I said, we've both done lots of these transactions from very small businesses, like deals for 100,000 to deals in multiple millions, like 50 millions, and everything in between. The first part of our webinar is really the fundamentals, like what you need to have in place before you even begin thinking about a sale. So I'll ask Samara some questions. She'll let us know based on her experience. I may chime in, and then at the end, if you guys have questions, definitely feel free to ask us. So first question is, why is financial cleanup something that's important to prepare yourself for a sale?
Yeah, this is a really important one. If the buyer can't figure out your financials, they're probably not going to make an offer. So, investors, buyers reps, they rely heavily on accurate financials. And most importantly, they need to be up to date, they need to be clear, they need to be readily available. So what you should do to get them in that position is work with your bookkeeper and make sure your revenue, your expenses, costs, everything's current, accurate, and well documented so the buyer can just go in, boom, 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 here's everything, and not have to fish around for things.
And let's say someone right now is using like paper or Excel or something, just using like their EMR for their transactions. Like, what would you recommend they do?
Yeah, I mean, getting away from paper, so, electronic, making things easier. There's some, long-term, long-time sellers out there who kind of have, here's my stack of papers. And so it's, making it the most easily accessible with EMR and also, your individual billing and all that stuff too. It's just ready to roll.
Yeah, and if you guys need recommendations for bookkeepers or accountants or consultants who specialize in cleaning up people's financials, we can definitely put you in touch with someone. But yeah, like as Samara said, people need to see them in a clean way and they shouldn't have to work to try to figure out like what was your revenue. Or it shouldn't be like, oh, here's this paper, it's 50% of my revenue, and here's this paper. Like they don't like that. So what specific financial details are buyers looking for?
Yeah, the big ones are, revenue trends, looking at the last few years. Are you dropping off? Are you rising? Are you consistent? Profit margin, labor costs, cost of goods, going back to the clean financials so you can clearly figure out those things. And that'll help speed up, the buyer's due diligence and make the buyer confident, here are the revenue trends. I'm expecting it to go this way, and, I'm making an offer based on that.
And what about any unpaid debts or liabilities? What should be done about those?
So buyers aren't expecting to take on any seller debt at closing. Absolutely, those need to be paid off. Sometimes they can be paid off with a payoff letter if it's a certain loan at the time of closing, but they still need to be addressed in the beginning. So if you know you have debt, either pay that off beforehand or you let the buyer know, hey, my, big loan is coming out of my proceeds at closing. So that way everything's cleaned up and the buyer's taking, free and clear the assets.
Yeah, and what about billing systems and record keeping? Should that be set up before closing or could that wait?
Yeah, absolutely before closing. You want it to be turnkey. You want the buyer to just go in, just sit at the desk, turn on the computer and everything is there ready for you. Down the road, they want to implement different software. That's fine. But you want, day one to be up and running, and you want to put the buyer in the best position to succeed with well-documented, efficient systems, records, payroll, compliance, basically all of your systems, ready to go for the buyer.
Got it. Okay, perfect. So now moving on to positioning your practice to get the maximum value. Let's talk a little bit about what that means and what people can do today to get the most value, let's say a year from now or 6 months from now.
How do you know if your practice is actually ready for someone else to take it over?
I think that it's really a function of can the practice function without you, right? A lot of it is if the practice is really reliant on you as either the provider or you as the manager to tell everyone what to do, to monitor people's clock in and clock out times, to clean the bathroom, whatever it is that you're doing, if it's relying on you, then it's probably not ready for maximum value. You could probably sell it, but your buyer, the first thing they're going to say is, okay, so how long are you going to work here after the sale? And if your vision is not to work there, then the best way to get more value is to get somebody else in there as like someone who could work there and really run the business. It doesn't have to be one person necessarily. Like it could be a great provider plus a great manager, or that could be combined in one person. But if that person is you, then to get maximum value, you're going to have to be the one of the things that comes with the sale.
And it's distinguishing yourself, from the brand. If you're just the brand and you're not staying on, then the brand goes away.
Yeah. And if it's like Sarah's med spa, they're going to want to know like how long is Sarah going to stay? Also thinking about positioning your brand. Like if your brand today is Sarah's med spa, thinking about maybe even changing the name or letting some of your other team members take like front and center so that people aren't just expecting to see you.
Now, how do you figure out what kind of buyer to target?
Well, one is talking to consultants who know the space pretty well. So one way is to think about is it going to be one of your competitors, like a strategic buyer, not necessarily your competitor 2 blocks away, but maybe someone who has a med spa or another type of business in the same town, or you could be bought by a private equity group, for example, that's looking to enter into the space in your city. But a lot of these types of buyers have minimal requirements. So, for example, for a lot of private equity groups today, they're looking for practices that at the very minimum would do 1 million to 1.5 million in revenue and have an EBITDA, which we'll talk about what that is, about 300 to 400,000 at the very least. So for a lot of people who are not at that level, you may want to think about a strategic buyer. So someone who is a competitor, but maybe not your direct competitor, because you may not want to release all your information to them. But we could also talk about how to protect yourself from that situation as well. But sometimes there are people who buy med spas who are not in the business yet at all, who are looking to essentially get into this industry. So we've had transactions where the people buying were not really experienced med spa operators at all. But then part of your deal for it to be as successful as possible, you would kind of stay on as a consultant to them for some time. And of course, be compensated for that.
Now, you touched on it a bit, but how, what are different ways to value practices? How are they usually valued?
It's really all over the place. It's like you get what you negotiate in some ways, and also depends on how many people you speak to. So the lowest valuations typically happen if you're just speaking to one place and you take their first offer. Best valuations are if you spoke to multiple places and got valuations from them. But the first step is really getting an independent consultant to value your practice. So we have a couple of consultants that we work with all the time that we could recommend, but essentially they would come in, you would show them your books. And when I say come in, I mean you would just email them your information and they would put a valuation together, a whole report about your practice. For single location practices, we're seeing something like 2 to 4 times EBITDA. And for larger multi-location practices, I would say 4 to 10 times EBITDA common. And you could see it's a pretty wide range, right? Like 10 times is way bigger, but it really depends on how clean your books are, how reliant the practice is on you, how long you've been in business, and then what the hidden liabilities in the business are. So if you say, well, actually, we're dependent on, this and this continuing, or we this our revenue is super high, but our monthly loan expenses for our machines are 50,000 a month, like that'll affect your valuation as well.
Yeah, and I think a lot of times first time sellers come in and they kind of have an idea and say, oh, my friend got this for their practice, and their friend might even be in a different state. So it's such a practice specific thing and how to value your practice and, how many locations and where it's located and all the different factors that go into it.
And oftentimes we see from the letters of intent from different places, like one place may value your practice at 1 million and another place may value your practice at 3 million. So it's really a wide range, and it's about getting you the best price. So what we typically do is have our clients shop around and make introductions so that people can get the best value for what they've built. But at the same time, sometimes the people that you may be speaking to try to talk your valuation down for some different reasons. They may say, well, yeah, your friend got this, but actually, your practice is worth something else. And the only way to really confirm that is to ask the market. So getting other opinions is really important. So in your experience, I think you've done lots of deals like of all sizes. What are some of the differences that you've seen? Like, have you seen somebody offer someone like, I don't know, 1 million and somebody else offer them two or five, or I don't know, tell us some stories.
Yeah, I've definitely seen, some pretty far apart negotiations. And I think sometimes, like you were talking before, where you're the brand and people think, I've done all this and, it's kind of your baby and you want to maximize the value, but also you have to be realistic with it too. And, the numbers don't lie, the numbers are what they are. And it's, there's kind of the goodwill part of it too. But I think it's, being fair, being reasonable, and eventually those people who are so far apart just magically meet in the middle because they realize, oh, okay, I'm underselling how important the seller is from the buyer side too. Even if the seller's not staying on, all the patients love this particular seller and their, patient retention and kind of different things that go into that. But I think it's kind of even as far apart as they are. And, I've had some people where I just met them and together, I'm like, I don't know how these two are going to work, but kind of at the end of the day, with talking and being open about it, even the farthest apart buyers can come together actually.
Yeah, definitely. I think deals can usually be done if both parties are willing. And then there are protections that can be built into the deal. So, for example, a lot of deals these days are not 100% cash. And that's a big negotiating point too. Like you may ask for 100% cash for your practice, but somebody may say, no, I'm only going to give you 30%, and the rest is something called an earnout that you can get based on different targets. The thing is with that, it's much more risky for you as a seller because once you're no longer have control of the business, it's hard to really control the performance of the business. But if your earnout is 100% based on, let's say, revenue, we've seen situations where I would say relationships really break apart, where let's say a buyer is expecting a certain kind of revenue and a seller is expecting a different kind of revenue, and then the targets are not met, and a lot of money is owed and people sue each other after the sale. So we try to draft the agreements so that they're tight, so that there's as little variability as possible. So everything is really spelled out. So everything in your control, you get paid on. But if it's not in your control, it's hard to make you responsible for it after the sale.
Yeah, I think with earnouts too, you can get pretty creative with them too. There's so many kind of different ways to play around with it and get people comfortable and, tie certain things to the earnout.
Yeah, definitely. And then another thing that we see a lot is, let's say you have some key staff that you want to make sure that they stay during the transition. So what you would do is typically put some bonuses in place where if they stay past the closing, and let's say a year after your deal closes, they get a certain amount of bonus. So then that way they have this retention bonus in mind and then they're not leaving. That's one way. Another way we've seen people do it is something called phantom equity, where let's say you have some key employees today and you may be thinking you don't want them to leave, but maybe you're going to have a sale in like 5 years. So you would put something in place, a plan with them where they're not true equity holders today, but if you have a practice sale, they're going to get paid some certain amount or some percentage or based on some formula. So there's a way to do that without actually giving them equity today, but incentivizing them to essentially stay. So we talked about some fun things about selling your practice and the positives, but we've also seen a lot of deal killers and what can go wrong. So the next section, we're going to talk about what are some of the common deal killers and how to avoid them. The first part is what are some of the most common deal killers that can surface in this kind of transaction?
Yeah, I'd say maybe even the top one is, lack of honesty, lack of transparency. So, for example, there's a pending claim, some kind of malpractice claim against the seller, and the seller's pretty sure it's going to go away, says nothing. And then the buyer, just kind of snooping around in due diligence, finds out, whoa, there's a claim. And, that's obviously going to make the buyer uncomfortable. So, either resolve it prior to selling, and as you get your practice ready to sell, that's definitely on your to-do list when you have time to do that. Or if, there's a shorter timeline, you need to disclose it to the buyer and figure out, how to handle it and what to do, because you have to assume the buyer will find out something like that. And besides litigation, it could be, an employee issue, equipment, something's broken, but maybe they won't notice. It's definitely getting ahead of it. There can be all kinds of solutions to it. So there can be a credit, let's say, for a broken chair or something like that. But the buyer's going to be turned off if they find out that you weren't transparent up front.
Yeah, nobody wants to do business with a liar in who in their mind they can't trust. So that they're thinking, even if it's a small thing to you, it's much better to disclose it than not. And a lot of these buyers have very detailed due diligence lists, and we could send you a sample of one if you're a member with us. And they're asking a lot of questions. So if you don't answer the questions fully or honestly, they will know. And a lot of times in these agreements, there are provisions that said you as a seller represent and warrant that you are 100% honest and transparent in this due diligence. So even if you didn't disclose it and technically they didn't ask you directly about it, but if they sent you a due diligence list and you just didn't complete it or didn't list this thing on it, you could still get into a lot of trouble. Another question that comes up is before listing your business for a sale, what are some of the things that you should do?
A lot of times sellers come and they say, great news, I've agreed on everything with the buyer. We have the purchase price, we have this. And then we go to put it on paper, and the buyer or the seller says, no, that's not the amount that I remembered. So basically, once you verbally agree on anything, you need your lawyer to put pen to paper. Whether, you're making an offer, reviewing an offer, you need to look at it. And then internally, you need to look at your legal documents, your tax documents, your compliance documents, and make sure everything is up to date, because it all has to be above board because you're transferring things over to the buyer.
Yeah, so related to that, let's talk about the letter of intent and what that is.
So the letter of intent is a non-binding document. Typically, the only binding sections are confidentiality, that both of you will keep the offer confidential and agree to pay any costs separately associated with preparing or reviewing the letter. And it's basically when you do kind of a meeting of minds of the terms, so purchase price, non-compete, due diligence period, any financing contingency, if there'll be a bank loan, what are the included assets? Maybe there's certain things that aren't. So excluded assets, also, accounts receivable, different ways to handle that. Are those in the purchase price? Are they going to be collected by the buyer on behalf of the seller? And so once you kind of have the general terms, it's a pretty short, simple document, but it's basically an outline before the larger purchase agreement will be prepared. And so that way you don't get too far down the road and you both realize, you kind of talked about the purchase price or kind of threw out a non-compete, but you didn't actually agree to it. And it doesn't have to be so detailed with, every single thing. But one of the other things that I like to put in there is, if the seller is staying on, and just a general time period. So
Mhm.
that way, if the buyer's like, hey, I don't really want you to be here, and the seller's like, oh, I thought I was just going to hang out for 3 years, then, we have a pretty major issue once we get to the purchase agreement and post-closing employment agreement stage.
Yeah, or on the other side of that, sometimes the seller wants to run away and go on a year-long vacation after they sell, which is fine, but the buyer just needs to be aware of that and not be surprised by that in the purchase contract. It's good to have these things ironed out in the LOI. It saves you a lot of time and money in the purchase contract stage because if you have a meeting of the minds in the LOI, then it's much better to just draft a contract. But if you didn't have a meeting of the minds, you just go to the contract then you're negotiating a 50-page document versus negotiating, something 5 pages. And you could be under an LOI with multiple parties at the same time, as long as it's a non-binding LOI. So a lot of times people come to us and they're looking for a buyer. We would have them talk to multiple prospective buyers at the same time. So it's not like an LOI binds you for life, it has to be exclusive. There are different types of LOIs too. So some LOIs will have a exclusivity period or an automatic renewal period that says you can't negotiate with other people for X amount of time. But that's another thing where you don't want to just blindly sign an LOI either. Have your lawyer review it, because a lot of them, especially with the private equity groups, they try to lock you in to exclusively negotiate just with them for a while, but that may not be 100% advantageous to you. Let's talk about the different types of deals, like a asset purchase versus a stock sale, and what those mean.
Yeah, so asset purchase is you're selling the actual assets, the equipment, and the main difference is in an asset purchase agreement, the buyer is not taking on any debt, any liability. Stock, the majority of sales are asset purchase agreements for practice sales. Stock purchase agreement, you're buying into the seller's current entity, and so you're purchasing the stock of, Samara PC or something like that. And in those, you have to be careful because you can take on some seller debt or liabilities. So, that's why the asset structure is more common. But, they're both viable structures. And one of the things with those is it's kind of a CPA question too. There might be some, accounting and tax reasons to do a stock versus asset purchase sale. So it's definitely something to check with the CPA kind of in the beginning with that too.
Yeah, and with both of them, you usually have lists of assets and liabilities that are one of the schedules of the document. So hopefully you won't be surprised if you're the buyer or the seller with something that wasn't disclosed. So even in a stock purchase, right, the company would list what its current assets and liabilities are. But because you're buying actual stock of the entity, technically, if you have a lawsuit come, even if you had a indemnification in the contract, if you have a lawsuit that comes a year from now, you still may be tied up in it because you bought the whole entity. So sometimes that happens. Another thing to think about is, let's say right now your company is a PLC or a PC. Um, you can't really sell stock of that company to a non-medical buyer. So by definition, you may need to do an asset sale, because otherwise there's not like an easy way to do that. At the same time, what some of these buyers can do is they would find a medical person to buy the asset, to buy the stock of your medical entity. So there are workarounds for all these things, but they get pretty technical, and we could talk about those on a one-on-one consultation with someone. Let's talk about transition planning and how important that is, or is it important?
It's definitely important. Sometimes people get wrapped up in the yay, like we're getting to the sale, closing's happening. I did all the stuff you just told me in this webinar to do, and then it's wait, now what, right? So it's kind of before, in the early stages too, figuring out, like you said before, maybe you want to run away. Great. So that, you need to let the buyer know I'm running away. And, there are different options, right? So one is you disappear the day of the closing, depending on who the buyer is too. If there's a private equity group, you can, still maybe run the practice for a few years after that. If it's a kind of a one person buyer, they might not be able to support two doctors or two practitioners from a revenue standpoint. And so, if a seller's staying on, there needs to be some kind of employment in place, unless it's a really small short term that maybe you can kind of throw into the purchase agreement. And then what that role will look like. Will it be a clinical role where the seller is still practicing, or it be consulting, maybe advising? And they're all kind of, different options. And for sellers, it's kind of one of the things I tell them, if someone comes to me, I'm even thinking about selling, is what do you want your future to look like after, the sale goes through? And to really give it some thought. It shouldn't be a hasty answer and just, oh, I'll do whatever the buyer says. It really should be, what you want, and then can kind of work with the buyer to figure out if that works for everyone.
Yeah, and a lot of the private equity buyers do want sellers who are going to stay on for not just 1 year, but 3 to 5 years. But they are willing to incentivize people in a really big way to stay. I mean, I'm seeing very good employment contracts plus benchmarks and goals for based on revenue. So you may be getting more base salary than you ever had before, plus bonuses based on achieving something. So they will incentivize you to stay, and they usually want you to stay. The private equity side does. But you have to ask yourself, like, is that really what you want to do? Do you want to work for someone for the next 3 to 5 years, or do you want to go travel or something else? Any other words of advice based on all the many deals that you've done?
Yeah, I think that it's, even if you're even thinking about it, it's not too early, to talk to your attorney and kind of figure out a blueprint. Maybe it's in 1 year, but kind of the things we've talked about, get your books in order and just leading up to that and what you should be doing if you need to decrease kind of your time in the office and have another provider or something to kind of distinguish it. And really it's not too early. These are things you should be thinking of. The last thing you want to do is feel rushed and just kind of, okay, now my timeline's here. It came up and I didn't do all of these things that I, needed to be doing.
Yeah, and these things take time. I think we see it maybe 6 to 12 months on average for from beginning of someone deciding, okay, I want to sell my practice to actually finalizing a deal. So it's not something that happens right away. But the more time you have to prepare everything, the better things go. So even if, let's say today your practice is experiencing a downturn for because of the weight loss thing, because of some other things, it's still not too early to say, okay, maybe I have a little bit more free time now, let me think about what I need to have in place to position my practice for sale in a year or 2 years from now.
Yeah, and I think the other thing is it's a lot of the legal side of this, it can be very nuanced. And you can't just have a bankruptcy attorney or a real estate person, who's never been in this space. It's really, healthcare specific stuff that you wouldn't necessarily know, if you haven't been an attorney in this space and just kind of thinking about, those things. It's not just, pull a 2-page agreement, let's all sign it, and yay, we've closed. It's much more involved legally. So, healthcare specific attorneys and healthcare specific CPAs too are kind of the best people to help you here.
Yeah, definitely. Thank you so much for your time. Thanks so much for doing this webinar. We're trying to do these once a month for ONGIA members. If you guys have suggestions for webinar topics, let us know. And Samara, thank you so much for taking the time to do this webinar with us. It was really great. And your experience doing so many transactions is super valuable.
Thanks, appreciate it. Thank you.